Welcome. In this video, ZBCN coin makes us rich. We will analyze it. Don't forget to subscribe and like, and please watch to the end to understand. When the chart is examined in depth, it becomes apparent that recent price movements are shaping within a falling wedge formation. This structure, which is well known in technical analysis and often produces reliable results, is generally considered a bullish pattern that signals the potential for a strong upward move. Analyzing the current price behavior, we observe a tightening consolidation within this wedge. The price's repeated touches to both the lower support line and upper resistance line strongly validate the integrity of the formation. Falling wedge formations are particularly important structures that tend to appear near the end of downtrends, indicating that the price is becoming more resilient to selling pressure. The core characteristic of this pattern is that the declines become increasingly weaker, with each low breaking less forcefully, while the highs also descend but with diminishing momentum. This setup suggests that sellers are losing strength and that buyers are slowly preparing to step in. Once a falling wedge is broken to the upside, it is typically followed by a sharp, high volume, and sustainable rally. The falling wedge currently visible on the chart is progressing in a very symmetrical and textbook manner. The price continues to consolidate between the upper and lower boundaries of the wedge, and as this compression tightens, the market seems to be approaching the verge of a breakout. One of the most critical aspects of such formations is the direction of the breakout. In falling wedges, this breakout is most often upward, as observed in many historical cases and supported by statistical evidence. At present, the price is moving toward the upper boundary of the falling wedge, and upon testing this level, there is a strong probability of a bullish breakout. Such a breakout would restore investor confidence and confirm that buyers are gaining control of the market. If this breakout occurs, previous resistance levels may be surpassed, and the price may gain upward momentum. This scenario would present a highly favorable outlook for both medium and long-term positions. In falling wedge patterns, an increase in trading volume during the breakout phase is especially critical. A breakout supported by volume strengthens the validity of the formation and lays the foundation for a sustainable upward movement. If the price rise is accompanied by strong high-volume green candles, it marks the first significant step of a technical uptrend. For investors, such breakouts not only offer short-term opportunities, but can also be viewed as the starting point of a trend reversal. Furthermore, the fact that this wedge is forming at a historically strong support zone adds even more weight to its potential. Structures that develop in such areas typically indicate that the market is in a decision-making phase. If an upward breakout occurs, the result is not only technically positive, but also psychologically impactful. The uncertainty in the market shifts to renewed confidence, encouraging buyers to enter the market decisively. As the price approaches the upper boundary of the falling wedge, market participants are closely monitoring this level, standing by for a possible bullish breakout. At this point, any upward movement could not only benefit investors already holding positions, but also trigger new entries from outside observers. This can create a chain reaction that pushes the price even higher. Such a chain effect may lead to rapid upward movement in a short period of time. If a breakout to the upside does occur, it is highly likely that the price will quickly reach its target levels. In technical analysis, the target after a falling wedge breakout is usually calculated by measuring the formation's widest height and projecting that distance upward. But of course, we cannot rely on the pattern alone to make our final analysis. Let's also take a look at other metrics. Stay tuned. When the chart is carefully observed, the level marked by the prominent red line clearly stands out as a technically significant resistance zone. This level represents a critical threshold that the price has tested several times in the past, but has failed to break through. From a technical analysis perspective, such levels attract considerable attention from market participants, as a breakout above this point could signal not just a short-term move, but a much larger and broader bullish potential. This resistance area has also historically acted as a turning point for the price. In previous tests, buyers struggled to push through this region, and sellers stepped in to pull the price back. However, this time the situation appears different. The price is approaching this level with strong momentum, and if it manages to push above it, a whole new chapter in the market could begin. A breakout above the region marked by the red line would not only mean breaching the current resistance level, but also surpassing the all-time high, 88. The 88th is a level eagerly watched by every investor, where market psychology undergoes a complete shift. Once this level is broken, there will be no technical resistance ahead, and the price could gain bullish momentum into uncharted territory. This is why this red line is not only technically important, but also serves as a critical psychological threshold. Breaking above this level would indicate a renewed sense of confidence in the market and confirm that the bulls have taken full control. In such a scenario, investors would not hesitate to increase their positions, and with new buyers entering the market, demand would rise significantly. This would shift the supply-demand balance in favor of the bulls and accelerate the upward price movement. Especially large investors who have been closely watching this level may initiate aggressive buying once they see the breakout confirmed with volume. These kinds of breakouts are typically accompanied by strong and long green candles. This signals that the rally is not random, but rather backed by strong conviction and force. Testing new 88ths attracts even more investor interest, as there are no prior resistance levels in these regions. The price starts to move in areas it has never been before, making the rally technically limitless. This phase is called the price discovery process and usually results in increased volatility, but also opens the door for extended upside potential. If the price moves above this red line, a significant shift in investor psychology is likely to occur. Investors who were previously skeptical or cautious would now see this breakout as a confirmation signal and wouldn't hesitate to enter the market. As a result, a strong, bullish wave driven not only by technicals, but also by sentiment is triggered. These kinds of breakouts amplify the FOMO, fear of missing out effect, causing more investors to enter the market. This dynamic further supports the upward move in price. After a breakout, it becomes possible to define new technical targets. Typically, the resistance area where the breakout occurred begins to act as support. This means that if the price returns to this level, buyers are likely to step in and push it back up. In technical analysis, this is known as a role reversal. In other words, a level that once served as a major obstacle now becomes a base for further upward movement. For long-term investors, this breakout not only represents a short-term profit opportunity, but also the potential beginning of a larger and more sustainable bull market. In such an environment, the long-awaited major rallies may be ignited. As new 88ths are tested one after another, investors will find even greater motivation to increase their positions. The ATR indicator on the chart is currently trending down, indicating that the market is currently moving in a calmer and lower volatility. While this indicates that the price is on a stable footing in the short term, it also signals that a major move may be in the pipeline. This is because the narrowing of the ATR usually represents a moment when market participants are indecisive, waiting for a directional choice. This often signals a strong breakout in one direction or the other. Such a decline in ATR is actually a signal of a potential reversal. This is because, although a drop in volatility represents a calm market, the ATR spike that follows such compression can be the trigger for sudden and sharp price movements. Such periods of low ATR in particular provide traders with a period of preparation. Positions can be taken as the price moves through a narrow range and can quickly turn into gains as the ATR turns bullish. ATR shows us volatility. Yes, friends, I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming. Be careful in your investments, analyze the risks correctly, and always take strategic steps. I will be with you with different analyses, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon.